Hi, everyone. Welcome. I'm glad you could make it to hear our market update from NexMetro Communities. My name is Greg Fedorinchik. For those of you who don't know me, I'm the head of investor relations and equity capital markets at NexMetro. And I'm here with Josh Hartmann, who many of you probably already know, who's the CEO of NexMetro. And Josh is going to start with a little bit of a background on who we are for some of you who might not be that familiar with us.
Yeah, so I'm sure a lot of you know this background, the history of NexMetro, but we thought we'd give a little bit of a background for those who don't. NexMetro was formed in 2012. We had an idea that we would develop a hybrid housing product. It's got all the attributes of a single family home. So we're building single story detached homes at the backyard, but it also has the attributes of apartments where we have full on-site maintenance and property management. And the concept hasn't really changed that much in the last 12 years. And we've been improving the product, but it's relatively the same, right? We're still building single story detached homes for rent with really more apartment type attributes on the management side. But we've grown tremendously. We started out in Phoenix, Arizona, and now we are in, I believe, 8 markets across the US. We have 70 employees and we've deployed about $2.8 billion worth of capital. So, but what's great about it is it's still the same concept. We're just refining and perfecting it. And we're very excited to be continuing on our journey with our investors who've been with us from the very beginning.
Yeah, Josh, I think it's notable that we've generated, 23+% IRRs for investors over a very long period of time. On average, about every 44 months, we've been able to double investors' money. I don't think we should suggest that we're always going to be able to do that, but I think there are points in time when we are going to be able to do that. And, just testament to the great product we have for renters and the great offerings we have for investors.
Yeah, absolutely.
One of the things that attracted me so much to NexMetro and to the multifamily space generally is really shown here. Multifamily has been one of the highest returning and most resilient asset classes among really anything. It's outperformed equities and bonds over the past 2 decades. It's been more resilient than other sectors of the real estate markets. And that's really one of the things that I think it has attracted so much investor interest and capital to the space. What really drives those strong fundamentals, I think, is that number one, there's a shortage of housing, which we'll come to in a minute.
Right.
There's new households being formed every year in the United States. Over the last decade, it's been about 1.6 million new households per year. And those dynamics have really what have created this market environment where rents grow. And they've grown very consistently historically. Post World War II, they've grown at about 3.9% annualized. And they've never been negative in any 3-year period. And not only that, they're correlated with inflation. They're a big piece of the inflation measure. And so you have this natural inflation hedge in the asset class.
Yeah. And we're able to really continually reset those pricing, the pricing monthly, right? So we're able to adjust as the market adjusts. We're locking in those current rents for 12 plus months. And so it's really dynamic versus maybe an office, for example, or industrial, or maybe you have one tenant. And if that tenant decides to move on, you've got a big problem. But with multifamily, you've got 200 homes, you're constantly churning over those residents and you're bringing in new rents and making adjustments to the market. So it's much more dynamic than some of the other commercial real estate segments.
Yeah, and I do think that's why it's so attractive over the long term and why it's such a nice inflation hedge. This next slide really just shows, again, that there's a persistent housing shortage in the United States. And depending on who you talk to, different sources might estimate this differently, but all of them, I think, that I see suggest that there's a housing shortage somewhere between 3 million and 6 million units.
Right.
And if we're not filling that gap every year, as we noted on the previous slide, we're forming 1.6 million new households per year. The capital markets have to be working well and builders have to have access to capital to fill this housing gap, or we're going to have, it's only going to get worse. We're going to have a worse housing shortage as we look into the future.
Yeah. We've had people have talked about the boom in development of new housing in the last couple of years, but we still haven't caught up. And now housing is slowing down, as we'll talk about. New starts are slowing down. So, I think that the challenge of housing is only going to get worse. It's good for us, obviously not great for society to have this shortage of housing, but we're trying to be part of the solution by delivering great new housing. And we think the demand is going to be there for quite a long time.
Yeah. So we've seen rentership continue to grow in kind of a linear way in the US over the past couple of decades. And we expect this to kind of accelerate right now for a couple of reasons. One is there seems to be more preference among millennials and Gen Z generations to rent. They like the flexibility and the lifestyle, and we'll get into that a little bit more in a minute. But we're also now starting to see adults over age 55 also choosing to rent, whether it's an affordability issue or a preference issue where they want flexibility to try out a new area that they're thinking about retiring to or whatever. We're seeing this grow and we expect to see it grow faster. And the next slide, I think, kind of hints at why that might be the case in the next couple of slides.
Right. We talk a lot about at NexMetro. We try and let the data lead us to our decision making. And so we spend a lot of time surveying our residents. Of course, as our investors know, we spend time surveying our investors as well. But particularly with our residents, we want to understand what their preferences are, why they rent with us, and what their preferences are in the long term. And what we've seen is, and it's showing here on the right hand side, is 75% of renters say that really fits their lifestyle. And it's true, and it's not just perception, that the cost of renting a 3-bedroom home is much less expensive than the cost of owning a 3-bedroom home or buying a 3-bedroom home. We'll talk about that a little bit in future slides. But our residents really want to live in great neighborhoods. They want to be where services are. They want to have lifestyle services in addition to other services in that area. And we really focus on those core locations, and we're very disciplined to underwriting the locations of our middle projects as much as anything else, because really it hasn't changed, right? Real estate is location, location, location. And we want to understand what things our residents are looking for, which helps drive us to the right locations in addition to the right amenities and the right things in the home, et cetera. But it's really driving preferences in our space today.
Yeah, and we've talked about this a bit, the housing affordability crisis, and it's a reason why we expect to continue to see, strong demand for rental properties really across the United States, but particularly in some of the Sunbelt markets that we're in. You can see the quote here from last year from the Wall Street Journal that there's never been a worse time to buy from an affordability standpoint. So they estimate it's now 52% more expensive to buy a home than to rent. Our analysis suggests that in most of our markets, when we make pretty conservative assumptions about median home values, down payments, rent and mortgage and other expenses associated with home ownership, that you get to this estimate where in our markets, it's about $1,000 more per month to own a home than it is to rent a home. And for someone with a $130,000 to $140,000 median income, which is kind of in the range of what our median renter income is, that's a lot of money.
Yeah, it's meaningful. Yeah, and I just read this morning that in the last year, home values have gone up almost 4% last year, which is double the historic long-term growth rate for single family home values. So it's just getting worse, right? The affordability is getting more challenging. And I don't see that changing anytime soon. It seems like the home builders have figured it out. They're not providing more supply than the market is demanding right now. And so those values continue to go both on the resale homes, which there's very few resale homes available, and also on the new home sales. And so, it really provides a great tailwind for delivering a really outstanding rental product to this consumer.
Yeah, I mean, I guess that's actually sort of shocking when you think about, mortgage rates, well, at 7% or so, are super high by historical standards. They're high over the last decade or two,
Right.
Really 2 decades. And that hasn't deterred, home buying and home prices from increasing pretty meaningfully. So again, it's another reason why we think really high quality rental housing is likely to continue to see growing demand over time. Some other things just in the current landscape in terms of financing the development of new projects like ours, a couple of things have gone on. So as interest rates have gone up, construction costs have gone up a bit. We've seen, some inflation, as we're all aware of. That has really deterred new developers from starting new developments over the past couple of years. So that top chart is from the Fed, and you can see housing starts have fallen. And if you sort of just kind of play with these numbers a little bit to see really what that magnitude is, housing starts are down this year in the first half of the year about 40% over the first half of the year last year, which is also down about 40% over the first half of the year in 2022. So we've seen a really pretty dramatic decrease in new housing getting started, which suggests the supply problem is only going to get worse and rents are probably going to continue to increase. At the same time, down below is just talking about the interest rate environment. So right now, we've obviously over the past few weeks, we've seen, over the past couple of months, we've seen the 10-year Treasury drop from 5% down to about 4%, so a 100 basis point move. We now are starting to see growing expectations that the Fed is going to cut multiple times before the end of the year. Those things impact the financing costs of new projects. So we're starting to believe with a lot more confidence that financing costs are headed in a good direction for us. So those things together, suggest lower supply, higher demand on a relative basis, and lower financing costs to get projects started.
Absolutely. The thing I've found about what I see in the media, and I'm not a media basher by any means, but what I've noticed is they're about 6 months behind what's actually happening in the real estate market. Not surprisingly, right? Because it takes some time for that to get through. But as all we're hearing about right now is supply, supply, supply. But we know in the industry that supply is actually dropping off because the starts are dropping off. And also we've seen the highest demand or absorption of multifamily units in history in the first half of this year. So yes, supply was high. We knew that was coming, but also demand is high and that supply is dropping off, and it already has dropped off. So, looking a little bit into the future, the next headlines we're going to start to see is housing starts have dropped. Our housing shortage is going to get worse. I mean, you're starting to hear a little bit of that, but we're going to hear more about it in the next, 5 or 6 months. And I think that's going to start driving capital back in as that headline impacts investors, institutions, et cetera, which is good for us because the more demand that they have, the more excited they get about the market again, the more it's going to drive values. And speaking of values, let's talk about cap rates.
Yeah. Maybe just another comment on what you said. I think that's exactly right. So, people are talking about all the supply coming online. There's no doubt there's been a lot of supply coming online because when you go back 2 years, when these projects were started, interest rates were really low. It was easy for lower quality developers, for really anybody to make a project work, or at least present a pro forma so that made it work. I think that's interesting. And if you think about where we are in terms of occupancy across our completed or stabilized, or really any of our completed projects, we're still 90% and higher at, I think, almost every project that's been leasing for any significant amount of time. Mm-hmm. So the supply is tighter than I think people are really thinking about. Coming back to cap rates now, sorry about the long aside, but cap rates in this space have been really resilient over the last couple of decades. You've seen them come down largely because, some of that's financing costs coming down and right. The market is moving. What we've graphed on here is CoStar's Class A, 4 and 5 star. That's where our products fit. It's a 4 to 5 star Class A multifamily product. Over the last couple of decades, that's the dark line. The little bubbles are the projects that we have sold or recapped at different points in time. And you can see we've traded at a nice premium or a lower cap rate, a higher valuation than the market by about, 10 to 20 basis points on average over that period. Then you see the CoStar forecast of cap rates to go, up to above 5.5, maybe 5.75. That actually doesn't seem like it's going to happen. They're also forecasting cap rates to fall down as low as almost, 4.5%, or maybe lower again. And we just expect this to transpire faster than maybe the market does. We don't need that to happen for our projects to make money for our investors, but, obviously it would be a financial windfall if we found ourselves in that kind of an environment.
Right. Lower cap rates are always better for us. And yeah, I agree. I think this is a great graph that your team's put together because it tells us a lot of things. But the most interesting to me is that jump in cap rates, post today, which doesn't really make a lot of sense, right? It looks like it's actually coming down, and maybe even if there is a little kind of bubbling down, it's still going in the right direction. I think it really looks like it's peaked. The other thing that's really interesting, even though the cap rates that we've received are, call it 10 to 20 basis points lower than the market, that's meaningful, right? That's a pretty substantial value increase for the Avila product. It's kind of what I would call the Avila premium. And a lot of that's driven by the fact that there's not a lot of groups out there building what I like to call cottage style multifamily, the Avila product, Avila style product out there. And that makes it a product that is in limited supply and in high demand. And we think that's giving us that premium, and will continue to give us that premium on the valuation side.
Yeah, to your point about the dry powder in the market. So this is CBRE data where they look at all of the institutional funds that have been raised to deploy capital into the real estate markets. And so while we've seen transaction volume way down over the last couple of years, the last year and a half or so, some estimate it's down 50% or more. I think maybe even some say 70% in certain segments. You've now got what they estimate to be about $400 billion in institutional dry powder looking for opportunities to purchase different types of real estate investments. When you survey those investors and say, what are your preferred sectors to invest in? You'll note on the right chart that 75% of them say multifamily is one of their, top preferred areas of focus. So we just think as you see cap rates come down, as you see markets stabilize, as you see interest rates improve a bit, there's potentially an avalanche of institutional capital that's going to start seeking these opportunities. We've seen it a little bit. We've seen a lot of interest in any deal that we brought to the market, but I think people are waiting, and they're really waiting for, I think, the 10-year to kind of be stable for some period of time. And I think if we get that, we could see a major and significant increase in transaction volumes.
Yeah, I think it's going to be that. If we get the Fed drops rate even 25 basis points, we get past the election, quite frankly, I think that's going to be meaningful as well. Not because whoever wins, right? But uncertainty in the market that makes people nervous, and institutions are more nervous than most. And so I think once we get past that period, get into the latter portion of this year and into early 2025, and this capital is going to come rushing back in. And as soon as one group comes in, they're all going to rush back in, right? They all rushed out at the same time. They're all going to rush in at the same time, and that'll create competition and drive values. And I don't know if that's going to happen, in the next 6 to 12 months or 12 to 18 months, but certainly in the lifetime of the projects that we're talking about here, it's going to happen, which are, if we invest today, we're delivering homes in 2 years, and we're looking at exiting the project in 4 years. I feel very certain that we're going to be a much better economic environment at that time.
Yeah. I mean, I think right now the market is afraid of being the first mover and taking on too much risk. And I think that can transition very quickly to more of a fear. Instead of a fear of risk, it will become a fear of missing out. And I think you're going to just see capital flow into this space.
Yeah. Folks who are allocating for institutions don't get they don't get pats on the back for taking a risk, right? They're better off going with the crowd. And so someone's going to break that dam, and then it'll be off to the races again. So again, back to our original strategy at NexMetro was we wanted to be geographically diverse, and we wanted to build a business where we were delivering consistently projects in the markets that we're in, and they were in high growth markets. And so this really hasn't changed much from the beginning, and the markets that we wanted to be in probably hasn't changed that much, although the fact that we're now in them has changed. So, we started out in Phoenix, and then we moved quickly into Dallas and Denver, but now we're also in Austin, San Antonio, Atlanta, and Tampa. We have a few more markets that we would consider, but we're really focused today on, and again, kind of getting back to discipline on, let's really execute well in these existing markets. We've realized with time that we're able to actually drive down operating expenses, which is logical, right? If we get more projects in a market like Dallas, like Phoenix, we're going to see a compression of our operating expenses, which drives up NOI and therefore drives up value. And so our our original thesis of let's get into these markets and let's grow in these markets is really coming to fruition today. And it's something that I think is going to continue to improve. So we're not really looking at reaching out into new markets. And I get asked this all the time. Are you going into the Midwest or the Northeast, or the Northwest or into California? No. We're going to focus on these markets that are shown here and continue to execute on our plan in these markets, which I think gives our investors diversification, geographic diversification, and also investment diversification, because even within these markets, we're really developing projects kind of in that first and second ring suburban areas, so that if there's even some diversity in that sense. But we're very excited. We're excited about Atlanta. We're making a lot of progress there. We're excited about Austin. A lot of news about Austin having a lot of supply, generally in the central business district, but Austin also has tremendous job growth, as does Dallas. Dallas is the fastest job growth in the U.S. So we're feeling very good about these markets. I'm excited to be able to offer to our investors this kind of diversification in all the markets that everyone wants to be in. So that's we're kind of execution of our plan to date, right on point. And then we've got this great pipeline of projects that these are all going to be closed on, several of these already. And we're hoping to start construction on all of them between now and the end of the year. We've already started 6 projects this year. We've got 4 or 5 more that we're going to start this year. And again, you can see the geographic diversity, right? We're in Austin, Texas, Atlanta, Georgia, Phoenix, Tampa, and another project in Atlanta. Obviously, we're pretty deep into that market as one of our new markets. But and what's different a little bit about today versus the past for NexMetro is I think as a lot of people know, and you'll talk about a little bit on the next slide, we've changed our structure a little bit to where we're really bringing in the capital when these projects are shovel ready, versus bringing in the capital when we get our zoning approved. And then there's a few months of time where we're trying to get all the rest of the permits, et cetera. So it's way more efficient today than it was in the past. And that has really happened because of the scale that we've gotten to as NexMetro and some of the other financial resources we're able to bring to the table to the benefit of our investors. So I'm excited about just that change in structure. And I'll defer to you, Greg, to talk a little bit
as you know, I'm excited about the fund that we launched this year. And it's really just a collection of projects to help investors get diversification. Whereas we used to raise equity for projects on a project by project basis, investors would come in, they'd have to choose this project or that project. I would say what we have learned over time is we don't know which projects are going to be our best projects, right? There's a lot of skill and discipline because of what we do, but sometimes you have better outcomes at different projects because construction goes faster, lease up goes faster. Cap rates come down at a certain point in time when you're looking to sell a project. So it's really hard to identify what is going to be the best performing project in advance. What we do know is we've been building 3 floor plans, doing roughly the same 3 floor plans for 12 years. We've made some modifications based on renter preferences and feedback, but pretty minor modifications. So we have a really, really well developed and efficient model. We know what the costs are going to be. We've done this 50 times. And so putting that into a fund structure just made a lot of sense. Investors also said to us, hey, I'm sick of getting K1s for multiple different projects. Can we just sort of do some kind of bundling that makes this more simple? So we did that this year. We're excited that we're about 70% of the way to our fundraise, to finalizing our fundraise for this year. We're going to be invested in 5 or 6 projects, depending on sort of how we match up capital for the projects that we have identified for this year. And the fund is really just an exciting opportunity for people to get exposure to some of these both secular and cyclical tailwinds we just talked about. Other thing I would say, our team, our management team, is more heavily invested in the fund than they've ever been in any of our other offerings, which I think is a bit of a testimony to the confidence that we have in how the environment's unfolding in front of us. I don't know what else you would say, Josh.
I think it's important to note that this is not your typical kind of blind pool fund that is discretionary for NexMetro. What we try to do is really recreate the concept of your you're investing in Avila projects, you're getting the diversity. We're trying to put only projects in the 2024 fund that are going to start in 2024 fund in 2024. So this isn't a 7-year, we're not be calling capital for 5, 6, 7 years. We'll be calling capital for a short window. So it's almost like you've got diversification, but it acts like one project investment, right? And
I think that's a really good point. We designed this specifically to have some unique and attractive features for investors. I think that's one of them. Is you're getting pretty much immediate diversification, where when we're charging on committed capital, but the capital is going to be committed and deployed within 6 months. I believe 100% of it will be deployed within 6 months. So it's not like we're, gaming the system or making fee income, or that's not what it's about. It's about getting the thing invested as quickly as we can. And then having a 5-year fund life, I think, is super unique in our industry. So historically, our projects have been exited on average 44 months after we called capital. So we think targeting a 5-year fund life is totally achievable. And if things go well, we'll be returning somewhere between 1.6 and 2 times or more investors' capital over that sort of 4 to 5 year horizon. And I think that makes what we're doing really unique.
Yeah. And we're the builder, right? You're not investing in some unknown sponsor to be determined in the future.
Right.
Yeah. So I think everybody knows I'm a Warren Buffett fan. So whenever you see a quote from me, it's going to be from Warren Buffett, most likely. But I like this one. We don't have to be smarter than the rest. We just have to be more disciplined than the rest. And I really believe in this. We are super disciplined to our business model and our business strategy. We don't stray. I think a mistake that a lot of groups have made in our space is just building whatever product they could get approved. We're the opposite of that. We will only build our Avila product, and that's our promise to our investors, to make sure that you know what you're getting into. All of our partners, whether it's our debt providers, our investors, our asset management team, our development team, our general contracting partners, everybody knows what they're getting into when they do a project with NexMetro. It's an Avila project, and they're all very consistent and similar. So sticking to that discipline, I think, allows us to execute much better than most. And also allows us to deliver consistent returns to our investors, and it has proven that over 50 projects to date. So we're going to keep doing it. We're going to stick to our discipline. I'm a boring engineer, but that's just the way I'm built. And so I'm excited about what's in front of us. I think what you said is very meaningful. That our management team has invested more in this fund than any projects historically. And I think that tells you that they really believe that this is the time, based on everything that they're seeing in the market. And we believe that too. So we hope that, our investors continue to join us.
Yeah. So thanks for joining us for this short webinar. We hope that it's been interesting, that you've learned something, and that that it makes you more interested and excited about the prospects for what we're doing today. As Josh said, that we think the projects we get in the ground this year have a really great chance of exceeding our expectations, and couldn't be more excited about it.
Thank you, Greg. Appreciate it.